I'd like to introduce to you Mike Cagney, who is the CEO and founder of SoFi. And SoFi is an amazing company. If there was, Mike is going to tell us all about it, but if there's any analog to draw about SoFi, I think SoFi is closest to becoming the Amazon for financial services. And Mike's breadth and depth of his vision and his execution is truly remarkable, and I think he's just getting started. So Mike, why don't I, turn it over to you, and maybe you can tell us about the genesis of SoFi, and then the vision and the global ambitions.
Sure. So thanks for having me, and appreciate the time. So SoFi is the largest unsecured consumer lender in the country. We originate about $1 billion a month in unsecured loans. We do about $200 million a month in secured loans on the mortgage side, and that business is growing pretty rapidly. But we've been expanding into everything from insurance to wealth management to asset management for our member base. I think that the genesis of SoFi is pretty simple, which is if you're a 35-year-old and you look at what you want from a financial services relationship versus what you get, there's a big gap. And there's a lot of assumption about millennial customers that they're fickle, they're not loyal, they're price sensitive. And our experience has been the opposite. We actually find them to be extremely engaged, extremely loyal. They care about price, but it's the fourth or fifth thing they care about. And what they're really oriented around is this idea of speed, transparency, and alignment. Right? They want things quickly, on demand. They want it in a way that they understand what they're getting, and they want it from someone who's vested in their success. And the way that we've done that, manifested that, is through 4 key value propositions. First, we build product for this market. So we created student loan refinancing. It didn't exist before we did it. We dominate that vertical, but we've done equally innovative stuff on the lending side with mortgages and personal loans, on the insurance side with term life, on the asset management side now and wealth. We deliver everything through the phone and us via mobile. And that's critical because that's your ubiquitous branch. It's your 24/7 access. We run the highest service levels in the industry, so we run net promoter scores between 70 and 90 across products. But most defining in our business is we actually have a true community. So when you become a SoFi member, if you work at Google, you're the 25th percentile in salaries, we'll show you that information and we'll help you negotiate for a raise. If you lose your job, we get you reemployed. If you want to start a company, we'll help you raise capital, and we use our community as a starting point for your product. We hold networking events 2 to 3 times a week across the US. They're always oversubscribed. We now have dating events for our members that are massively oversubscribed. And if you're a romantic, unfortunately, what people wanted to see in the dating events was their prospective mate's FICO score and income. So sorry about that. That's what they want to see. So that's what we give them. And I just think it's a different way to look at things in the context of it's a community and we're all vested in one another's success.
Yeah, that's truly amazing. You just recently bought Zen Banks. How does that fit into your the execution of that vision?
So one of the things that we want to do, there's been 2 assumptions in fintech that have been proven wrong over the last year and a half. One is that fintech doesn't require capital. Obviously, fintech requires an enormous amount of capital. We have $1.9 billion of equity capital on our balance sheet, on top of $5 billion of warehousing. But the other is that somehow if you have an ever-increasing number of participants going after a finite customer base, cost of acquisition goes down. And it does, and it goes up. And the only way you drive down cost of acquisition is you have to be successful in what we call cross-buy. It's our more pleasant way of saying cross-sell, because we're not allowed to use that term anymore. And so to do that, you have to have a comprehensive product set. And if you think about valuation of financial services companies. So if you look at banks in the US today, they're worth between $5,000 and $100,000 a customer in market cap. And our view is we could have robust enough of a product set, enough cross-buy that maybe we're worth $50,000 a customer. And the cross-buy is already manifested. So if you look at our mortgage business today, half the mortgages we do are existing members, right? There's no active acquisition strategy there. There's no marketing dollars that we spend. It's just because they have a relationship with us, they like us, they come back, and they go through that channel. And so the Zenbank's acquisition was important because it gave us banking infrastructure that we could launch a bank account and a credit card, which we don't have today. And the biggest weakness in our value proposition, our thesis is we say, look, we're going to maintain that relationship, we're going to monetize it. Even though we make $2,000 or $3,000 or $5,000 on a unit economic basis per transaction, we think this is a $100,000 or $200,000 LTV lifetime value relationship. But that was always weak without having the deposit account, because if you had to put your check at Wells Fargo, that's your highest point of interaction, that's the highest point of cross-sell from their standpoint, and it always introduced weakness in us in terms of the LTV concept. And so what we've done through the Zenbank's acquisition is we have a technology platform that this year we will have a SoFi bank account, we will have a SoFi credit card, and in doing so, that kind of rounds out the full offering where we can be everything to our members, and that gives us a path to build into that lifetime value opportunity.
Yeah, so they never have to leave the SoFi ecosystem, never have to leave your brand, the platform.
Not for financial services, not for career advice, and not for dates.
Not for dates.
All of it within one stop.
That's great. Now, you have come up with this term, Henry, right? High earners,
not rich yet. Yes.
Right? So tell us about that. And then also, are you moving to institutional asset management as well?
So I think the issue is, again, the Henry is kind of that classic 35-year-old. And the biggest challenge as you're building out a business, the not rich yet part means, okay, I want to build a wealth platform, I want to build an asset management platform. Over time, that's an incredibly fertile business to build into. If you look at the 300,000 members we have today, almost 100,000 of them are accredited on an income basis, but they have very little in terms of assets. So if you look at our wealth product, balances start off very low, but about 88% of our wealth members contribute every 2 weeks. So they're putting money in, they're building that position, but they're not starting off with $500,000 or $1 million of assets. And so we want an asset management business that distributes product through our retail channel, and it's very difficult to start as a retail product, and so we started as an institutional product. And so we have been in the market. We're now on our second risk retention fund. The first one was heavily oversubscribed. This one will be oversubscribed, where it's effectively participating in the residuals on our securitization transactions, yields out low double digits. We are in the process of getting the infrastructure in place to build discretionary consumer because we feel we're somewhat uniquely positioned in the ecosystem in that we have our own capital markets business. So SoFi was the first to securitize non-bank consumer credit in 2013. We were the first to get AAA in 16, double AAA in 17. And we cover about 110 accounts ourselves that are buyers of securities in Asia, Europe, and the US. And so we're uniquely positioned to get deal flow, but we're also uniquely positioned in that we can underwrite loan pools and use our securitization shelf to create liquidity from them. We can assume servicing on portfolios that we buy. We can refinance premium portfolios or discounted portfolios to effectively crystallize the discount. And so we see an enormous opportunity in discretionary consumer, not just in our name, but in the broad name. And the benefit of us having $1.9 billion of equity capital and being profitable, we're starting a process of making market in some of these loan categories, in our paper in particular, but in other categories as well. And trying to develop the maturity of the ecosystem from an investment standpoint, because it's not been that mature up until now.
That's great. That's great. So how should institutional investors, we have majority of the folks here in this room are endowments, foundations, insurance companies. How should they think of working with someone like yourself and someone like other new lenders?
So I think if you look at the challenges in non-bank lending, there are reasons why we're not a bank. So all these things I talked about earlier, the career resources, the networking, and so forth, that manifests to a lower cost of acquisition for us. And so it gives us a sustainable advantage. The Wells Fargos of the world, in many ways, are prohibited from doing that thing from a bank holding company standpoint, but even if they could hold dating events, no one would go. So I was a Wells employee, so I can make fun of them long ago. So we have some comparative advantage that we build on cost of acquisition through things that we do as a non-bank entity. The issue in not being a bank is it introduces the challenge I talked about earlier around our customer not having that transaction account, and I think we've solved that. But then it introduces the challenge of not having determined and predictable liabilities. And so we rely very heavily on the wholesale cap markets. We rely very heavily on loan sale and loan flow agreements. We sell loans to banks, insurance companies, sovereigns, endowments. We're now selling to pensions. And this will only continue. This year we'll originate $16 billion of credit. Next year we'll do $25 to $30 billion of credit. And we sell everything we originate. So the balance sheet that we have, that $7 billion of capacity, that's there so that we don't have to sell loans when the market gets dislocated. We can actually retain our loans, even buy other people's loans in those circumstances, and then be able to take them back out to market when conditions improve. And so there's a huge need and there's a huge arbitrage for institutional capital here, because if you look at the traditional process of which you acquire securities, the banks originate them, they sell them to the dealer consolidates them up, securitizes them, it ultimately goes distribution. There's a huge amount of fees that are extracted in that process. And so we can circumvent that. And if you look at our investor base originally started with hedge funds. So Third Point was a big investor in SoFi. They were a big loan buyer. And they would buy whole loans and get 65, 70% advanced financing, and they could effectively earn mid-20s on the equity in that position on a maturity mismatch, but still mid-20s, sometimes up to 30% in that transaction. The challenge for us is relying on redemption capital is extremely difficult because we need to know the buyers are there. And so what's happened is we've evolved from hedge funds being predominant buyers to institutional money managers being predominant buyers. Now we're going direct. So insurance companies, as I said, pensions, endowments, sovereigns, banks as well, are all big buyers on the security side. And we're the only ones who bring prime consumer to market, and we bring it in size. And so the $1.2 billion that we do a month right now is not a limit on demand, it's a limit on the balance sheet itself, right? We originate to a point where if the market completely shut down, we could go for 12 months and retain everything that we originated and stay in the lending business. And so the way that we grow that is we either increase the size of the balance sheet, as we did recently. We raised $500 million from Silver Lake to grow the balance sheet out. Or we have more permanent capital takeout relationships where I might be selling loans in market at a 230 spread, and I agree to sell at a 275 spread, but you agree to take for 12 months. And we have that relationship where I know the takeout, and you know that you have supply. I think what's helped us in the capital markets is we've taken a very heterodox approach to credit in that it's not a FICO DTI-based underwriting model. We actually look at your credit history, but we look very closely at your cash flow. We want to make sure that you actually make more money than you spend. And if you look at our student loan refi book, we've done probably at this point 170,000 student loan refis. And that's not a student loan. That's someone who's graduated where we're refinancing them after they've graduated, where we can underwrite them. And I think our cumulative loss since 2011 is around 3 basis points in that book. If you look at our personal loan book, we run right now at about 1/5 of the loss rate of a cap 1 or 1/6, somewhere in that neighborhood for prime credit. So no one's been able to originate the kind of credit and the size that we've been able to do with the kind of loss characteristics that we have. And we think it's just, we have an advantage in terms of how we approached it.
Yeah, that's amazing. So being such a linchpin in this new credit system, what's your advice to institutional investors? Now you're prepared for nuclear winter, but what are you seeing from a standpoint of being in the midst of credit and technology?
Well, I just think there's enormous opportunity. Well, if fintech is successful, and it's unclear whether fintech's going to be successful yet, and a lot of the early entrants into the marketplace, I think, have struggled and not delivered in the value proposition that they were talking about in terms of something truly transformative. Mm-hmm. But if it is effective, if it is successful, you'll see change on two fronts. You'll see change in terms of the product offering and the service levels that individuals get. That's great for retail. Right. But I think you'll see a big change on the institutional side from an investment standpoint, in that there is an enormous arbitrage, especially in situations of balance sheet where there's permanent capital, to have that alignment where the capital source becomes what was the deposit base of the bank, right? And that's enormously valuable. And the biggest issue to anyone running a decent amount of money is how do you get into a situation where you get enough size to move the needle, you get enough consistency, you have the credit quality, you don't have a going concern for the business. There's almost no fintech business out there that's profitable, right? And that itself is a gating issue. Do you want to invest a ton of time and effort and resources into something that's a going concern? And so, I don't know that we're at the point where we're ready to have massive transformation. But I think we've been doing it at the market. We're a profitable business. We've been profitable for years. We make a lot of money, and we deliver consistent high quality credit. And as I said, we've done a good job segueing through a certain list of investors, and we're trying to build into a broader set, and in particular, the more permanent capital relationships that we can have.
That's great. And are you also using this model internationally now? I know you had some friends from Middle East come over. So are you doing this in Australia, Middle East, Japan?
So however big the gap is between a 35-year-old in the U.S. and their bank, it's bigger everywhere else. And so there's enormous opportunity internationally. And I think the Henry phenomena is not specific to the U.S. I think I could show you in the 6 circles around Beijing, there's probably more Henrys there than there are in California. And so there's an enormous opportunity outside of the U.S. The issue for us is really focus. And we're still in the nascent stages of what we're doing here, right?
What percent of market share do you have here? You have a lot to grow here as well.
Yeah, we're tiny, right? Just in student loan refinancing, for example, there's 300 billion of addressable and 50 billion that comes on every year that's new addressable, and we've done 13, 14 billion of that. Wow. So it's very nascent. Our mortgage business, we've done a few billion. That's $1 trillion business, right? Personal loans, we've done probably 10 billion of those, and that's at least a $500 billion business. So we're in the very nascent stages in the U.S. And I think what we'd really like to do is make sure we execute on our banking product, execute on our credit card, and then concurrently, we're doing a lot of the legwork from a licensing standpoint abroad. So in a lot of the regions that we want to move to, we started the licensing process. And I think there's really interesting regions out there. There's Asia, you've got Hong Kong, Singapore, but also China, Japan. The Middle East is a super interesting region that there's a big gap there in terms of service delivery and product, and obviously the capital to make that work. And obviously even in North America, going just up to Canada, tremendous unaddressed opportunity there. So it will happen, but the speed at which it happens is a function of how well we execute here.
Great. I know you're a venture-funded company, and you're a technology company first and foremost. So we hear a lot about machine learning, big data, and now blockchain. Are you using some of that in your delivery of services and quality of service?
So just to clarify, I'm a technology company here, but when the regulators come, I'm a financial company.
Okay, good.
Very clear, first and foremost, a financial company.
Okay.
That happens to use technology.
That happens to use
So I think AI and machine learning are the most overused terms in the Valley right now.
There you go.
I think I started at Wells in '94. I ran trading there. I worked for Tim Sloan, who's now the CEO. And we were doing some pretty cool stuff back then that MIT was doing around artificial intelligence, around genetic algorithms and neural networks for pattern recognition.
Yeah.
And I had this grand vision that it was going to massively transform financial services, and to this day, it hasn't done one thing in financial services. So, machine learning is as basic as, look, I'm underwriting, I'm identifying a loss pattern, identifying what the common characteristics are. People did this manually before, it's just now you can have a machine do it, but there's no transformative aspect that's happening there yet either. But we're on the cusp of that, right?
You're on the cusp, yeah.
So there's
big point.
There's some tremendous opportunity. I think blockchain is super fascinating. It's a great concept that's struggled to find a commercial application. Yeah. And the best commercial application for blockchain, and what we're doing right now is we do a lot of the skunk work project, is we're working on doing blockchain for title insurance. And if you think about title insurance, if any of you know, it's relatively a scam, because you're not really insuring anything. You're paying a lot of money to just have someone go to a courthouse and look at your liens or lack of liens on your property and sign off on it. And the idea of taking that and putting it in a public blockchain, whether it's Ethereum or Bitcoin or something else, and effectively using that medium as truth and then effectively encrypting it and selling the encryption fee, and that's the commercialization aspect. There's a tremendous opportunity there. The challenge is you need to get a county to agree to do a full-scale switch, because the blockchain wouldn't be enforceable if the paper records existed. And so getting a county to agree to do that on an unproven technology can be difficult, but we actually have one that's agreed to do it. So we are working aggressively trying to see if we can get this to fruition.